Stocks in Hong Kong are trading at their lowest in more than a decade as investors continue to sour on the health of the Chinese economy. The main Hang Seng index has lost more than 6% to start the week, while tech shares are down 8%. Data released on Monday showed the Chinese economy grew by almost 4% in the 3 months to September. That was better than forecast, but it did little to bolster market sentiment. Over the weekend, investors had been expecting Beijing to announce new stimulus measures to prop up slowing growth. Those never materialized, nor did the government provide any signal that it would move away from its zero COVID strategy that's weighed on business activity all year. Now, for more on the story, let's go to Han Tan. He's the chief market analyst at the Exinity Group in Abu Dhabi. Welcome back to the program, Han. Now, the Chinese government delayed the release of GDP data for the third quarter last week. Now that they're out, has it changed your mind? How does it affect your feelings on the prospects for the Chinese economy?
To be clear, I don't think it meaningfully changes my view on the Chinese economy. I think overall they're expected to continue stumbling its way past the pandemic, as you rightly mentioned, as long as it adheres to those to that COVID zero campaign, while keeping in mind those downside risks that are still evident and still persistent out of the very important property sector. Until those are moved away from, I think investors are more akin to look past the kinds of positive surprises that we saw in the data today, knowing that these persistent economic challenges are still in play.
So in the aftermath of the CCP Party Congress, where President Xi Jinping won another term as head of that ruling party, why are investors reacting so terribly, quite frankly?
Yeah, I think overall, if you take the perspective of a global investor, they will want to have more say in how markets operate, right? As opposed to a more tightly held, more controlled system that obviously the top leadership prefers in Beijing. I think, again, until there is more of a market-friendly reform, or at least signs of it, that the administration is more open to opening up the Chinese economy to global investors beyond just mere rhetoric. Until then, I think there's bound to be a healthy amount of caution surrounding Chinese assets, as we're seeing as we speak.
So can Beijing really afford to keep running its economy in this way? We know this is a major economy. It's the world's second largest, but a lot of the Communist Party's success has been tied to their ability to deliver sustained levels of rapid economic growth. But now that doesn't seem to be the priority.
Well, yeah, you're right to use that word priority, and it seems that political solidarity, so to speak, or at least enough folks towing the line. I think that is the main priority right now, despite the economic challenges. We note some of the noises, so to speak, emanating not just from the domestic scene, but also from the global stage as well. There is the potential for a further ramp up in U.S.-China tensions, for example. I think all that is clouding the Chinese economic outlook. And keep in mind, this obviously has major bearings on the rest of the world, a world that is already teetering on a global recession, perhaps by next year, because of the world's exposure and reliance on China. So it's imperative that they try to shore up growth as much as possible, although granted that might come at the expense of perhaps more political risks.
All right. Han Tan at the Exinity Group in Abu Dhabi. Thank you for joining the program.
Thanks for having me.